Most people invest for decades and never build income they can actually live on. Their portfolios grow on paper, but their cash flow, zilch. Today I'm going to teach you the Cashflow Investing Playbook, the exact system I've used personally and thousands of Infinity Investing members use to create real predictable income using dividend stocks and conservative option strategies. And yes, my full Infinity Investing book is yours absolutely free as an ebook. You can even get the hardbound version or Audible version on Amazon as well, but the link for the free ebook version is in the show notes. Absolutely free, by the way. For those of you who are new here, my name is Toby Mathis. I'm an attorney, an investor, and co-founder at Anderson Business Advisors. For the last few decades, my team and I have helped literally tens of thousands of investors, real estate investors, business owners, traders, legally reduce taxes, protect their assets, and more importantly, build wealth. It was a tale of two cities in some ways. Some of the clients were killing it, doing great. Some were not. For those who struggled, what I kept seeing over and over again was this. They thought they were doing everything right. They saved cash, bought nice homes, bought growth stocks, often were actively trading. Some were actively buying real estate, right? They were flipping houses. Many were even contributing to retirement accounts, but they still weren't getting ahead. Why? Because none of it created passive income, passive cash flow. In fact, Warren Buffett said it best. If you don't find a way to make money while you sleep, you'll work until you die. These clients lived off the last deal they did, their last trade, their last flip, but it was a job. They learned the hard way. They were house rich, cash poor. They were rich on paper, but poor on cash flow. The clients who did the best, they all had similar traits. They had multiple streams of income, and I'm going to kind of go over these: rents, royalties, dividends, interest, and capital gains from selling options. Those five. They built systems that continuously paid them whether they worked or not. And there's a big difference between working because you have to versus working because you want to, especially if the money is going right back into buying assets when you're working versus paying for liabilities. You see, they realized that they needed income they could spend without selling their assets. Otherwise, they just simply owned a job. At its simplest, an asset is something that pays you to own it. A liability is something that costs you money each month to own. An asset feeds you, a liability bleeds you. Many people are snookered into buying liabilities that they thought were assets. The best example was used by Robert Kiyosaki, from Rich Dad, Poor Dad fame. If you've never read it, you should. Your home, is it an asset or is it a liability? That house that you're flipping, asset or liability? How about growth stocks? Bitcoin, gold? It does not mean that you don't own them. It just means that the people who were most successful built their passive income machines first. Then they used the money that was coming off of that to pay for their liabilities. The concept of a passive income machine is the foundation of infinity investing, and I based it on real life success of a large group of people, and it continues to work wonders for those who use it. But how do you build a passive income machine? Well, that's the whole point of infinity investing. You see, infinity investing is straightforward. It's not flashy, but it works. And its core pillars are as follows. Number one, cash flow first. Growth second. Growth is great, but the growth of your assets doesn't pay your bills. Cash flow does. And there are the cases of things like Elon Musk and founders of big companies, but those are few and far between in the real world. And it is not an easy, duplicable strategy to create passive income. You cannot use it to eat, to live off of, until you have a liquidity event. Until then, it's really difficult, by the way. No, the group that is most successful is the group with cash flow. Cash flow that is created whether you're sleeping, on vacation, working, or goofing off. I believe it was Ray Dalio who said it. If your cash flow is dependent on the markets rising, you're not investing, you're gambling. Number two, buy assets that pay you. This is dividend stocks, rental properties, REITs, using option strategies that generate weekly, monthly, or quarterly income. Growth looks great on paper. When you have a stock goes up, it's like, wow, this is great. Cash flow pays the bills. Boring cash flow from things like dividends where inflation is baked into the cake. Personally, I like companies that have been paying and raising their dividends for decades. They're called aristocrats and kings. Kings, by the way, 50 years plus of increasing their dividends every year. And this just means that they've been through market cycles, but they always have enough cash flow, free cash flow is what it's called, to pay the most important people. Us, the investors, you and me. This is not like your crazy uncle you loan money to and he keeps promising to pay you back, right? This is money you can actually spend, that you can live off of, and it's only one revenue stream. The goal is things like rents, royalties, dividends, interest, and capital gains from the sale of options. There are 5. But if you get 2 or 3 of them into your life, man, it makes things so much easier. Number 3, avoid liabilities disguised as assets. If you have to sell it to get value out of it, it was never an asset. It was a liability on delay. An asset pays you to own it. A liability charges you rent to keep it. Put another way, a liability feels good when you buy it and bad when you own it. An asset feels boring when you buy it and wonderful when you own it. And there's that truth in this saying, right? The 2 best days of owning a boat are the day you bought it and the day you sold it. That is not the case for someone who buys assets. The only 2 boring days for them are the day you buy it and the day you sell it. The best days are the days in between when you're constantly getting paid. Number 4, follow the 70-30 rule. Live on 70% of your net income. Use the remaining 30% for debt reduction, investing, and giving. And let me just go over the rule real quick. When you're using the 70-30, that 30%, that's 10% in 3 different slices. The number one 10%, and I just see this from working with thousands of investors. We do over 10,000 tax returns a year here, and I can see who makes money and who doesn't. The people that give do the best. And so I say 10% giving. And by the way, if that's too stressful for you because you just don't make enough and you're struggling, then give time away, but don't give up on the giving. That giving is the secret sauce. We see it over and over again. The wealthiest people are voracious givers. So 10% of your net income goes to giving. 10% of your net income goes to pay off your debts. This isn't the amount that's baked into your monthly amount that you're paying already just to pay them off. Here's my bill. I want you to pay down the debt with an extra 10% of your net income. And then 10% of your net income goes into your investment account and is using the strategies, the cash flow strategies we're talking about. And I'll give you a starting point here in a minute. Number 5, invest automatically and consistently. This is important. You need to remove emotion and you let the systems do the work. It was Benjamin Graham, one of the greatest investors of all time, who said, the investor's chief problem and even his worst enemy is likely to be himself. In fact, there's multiple studies that have borne this out. For example, in Dalbar's quantitative analysis of investor behavior, that's a mouthful, right? Average investors underperformed the S&P 500 by 2/3. They averaged about 3 to 4% a year versus 10% in the S&P. If you just sat on it and did nothing, you're better off. Usually we're our own worst enemy. In fact, Fidelity had a bit of a scandal when its people admitted that the most successful investor accounts are brokerage accounts that are inactive, meaning people forgot about them, or the owner passed away and it's tied up in probate or it's tied up in some court process, or they're just inactive for a long period of time, right? The old joke in the financial industry was that one of the wealth hacks was simply to open an account, set it on auto invest and auto transfer out of your bank account, so you're putting money in there on a monthly basis, and then you lose your password for a few decades, right? Forget about it. If you did that, you'd end up very wealthy, right? We want to create a system. Like the moral of this whole thing is that a system will outperform willpower every single time. Number 6, use data, not hype, to buy stocks. Infinity Investing gives you a proven 7-point checklist. This is part of our system that prevents us from chasing non-mature stocks or something that happens to be getting a lot of press. We use this system to ensure our core portfolio is built around creating multiple streams of income, not whatever's popular. We like to use something called the wheel strategy here, right? We use cash secured puts and covered calls to add additional income streams to our investing while minimizing risk. We teach this for free, by the way, right? Just download your free ebook, go into the show notes, download it, and you'll receive invites to our free classes where we teach these strategies, including that wheel strategy. It's a game changer because instead of just making money on like hoping that your stock goes up, I'll show you how to make cash flow in at least 2 additional ways. And if it goes up, you win, yay. But we want the cash flow. Number 7, build wealth that outlives you. This isn't just about the next decade, right? It's about creating financial stewardship for generations. If your plan is dependent on your unique skills, then your wealth will be that much harder to transfer to somebody else. If you build a passive income machine, it is very easy to transfer. For those of you who want to build a legacy, which is multi-generational wealth, you need to build a passive income machine that that just continues to create wealth even when you're not around. You got to make it to where while you're sleeping, while you're goofing off, while you're traveling around, it still works. Traditional investing says accumulate as much as you can and hope the market cooperates. That's not a plan. That's a prayer, a hope, right? I hope it. Cash flow is different. When your assets pay you, and remember, it's dividends, rents, the options, all those things, right? You aren't forced to sell anything. And I'm just going to repeat those. Rents, royalties, dividends, interest, and the option premium from short-term capital gains. You get to keep the asset, you get to keep the appreciation, and you live off of the income. The market downturns become opportunities, not an emergency, right? So growth is hope. Cash flow is control. Now, people often ask why I focus so heavily on dividends and conservative option selling. Well, it's simple. Number 1, they're predictable, they're repeatable, and they work in all market conditions. Dividend stocks gives you steady cash flow from real companies making real profits. By the way, they're tax advantaged too. They can be at the 0 tax rate depending on what your tax bracket is because they're taxed as long-term capital gains many times. Covered calls and cash secured puts, they allow you to generate income, whether the market goes up, down, sideways, whatever, without speculation, more importantly, without gambling, and without leverage. Right? When you combine dividends with option selling, you create a steady, reliable income engine. That's your machine. In fact, if you're super lazy and you just want the cash flow, I don't want to do anything. There are ETFs out there, which these are big buckets of stocks that do it for you. For example, I've had Kevin Simpson on my YouTube channel over and over again, right? He manages over $12 billion and focuses on these same strategies. The tickers, by the way, they're easy to give you. DIVO, D-I-V-O for his domestic fund, and IDVO, I-D-V-O for international. Or if you're an accredited investor, you could hire his firm to just manage your money. You'll need a financial planner, which I can give you if you reach out. Again, go get the free book, become part of our community. We'll introduce you to somebody who then, if you want to have somebody manage your portfolio under these principles, you can. But you still want to learn the principles, but you don't have to do everything yourself. So I mentioned, by the way, the 7 tests. We use 7 tests when considering buying a dividend stock. Well, here they are. This is really easy. This is where Infinity Investing, by the way, really shines. We don't guess. We don't chase hype. We use a strict 7-part filter. Let me see if I can put my fingers up. 7-part filter to reduce risk and find stocks that can reliably pay income for decades. Number one, the chart price. Are we closer to the lows versus the highs? Has the stock been there before? We don't want the high flyer. We want the boring stock that's in a kind of a channel and we're buying it closer to those lows than their highs. We want to be very cognizant as has it been here before? Number two, the chart trend. Is it going up or sideways? Right? We avoid trying to do the catching the falling knife, right? We avoid the downward trends. We want things that are channeling, which are great. They're boring, or they're going up. Number three, option availability. We need strong, worthwhile option premiums if we're going to invest in something. We want to be able to make good money selling those options on it. And I'll go over what those are in a second. Number four, we want dividend yield. We want a minimum of 2%, and we want it to be consistent for at least 5 years. Now, I personally, I like 25 years. I like 50 years. I like these stocks that have been continuously paying. At a minimum, we say 5. Me personally, I'm leaning more towards 10, 25, 50 years. And the reason being because I know what I'm going to get paid. And by the way, they go up every year. So it says 2%, but you're getting a raise every year. They continue to grow. Every year you're getting more and more. And so, 10 years, 20 years from now, you're looking back and you're getting a much greater percentage versus what you paid for. And it just keeps going up. Take a look at Warren Buffett. He bought Coca-Cola, I think, in the 80s. And Berkshire Hathaway is still getting all that. Like, it's a ton of money every year from the dividends off of that one company. Number 5, revenue stability. We don't want to see any significant declines in the last 3 years. We don't want surprises. We want boring. Number 6, the PE ratio. We want it between 10 and 25, right? We don't want to be chasing these crazy valuations in companies. There's a place for it. That's called gambling, and you could still invest part of it, but we want to make our living off of boring, predictable cash flow. I don't want surprises. I don't want to chase. I want something that is, this is a great value. This is within a range that is very boring and consistent, and leave it at that. Number 7, the analysts do matter, right? So we want a majority that are buy and strong buys. We don't want the kind of neutral or bearish sentiment. We want things that, hey, the professionals out there recognize this is a good, strong company. Even if it's boring, we don't need to chase. Remember, we want to buy cash flow. And if a stock passes all 7 tests, it's usually a solid long-term income play. Keep in mind that there's no guarantees, by the way, but this has worked really well for a ton of people. We also avoid yield traps. When you hear about dividend stocks, a lot of people immediately go and say, I want 8%, 10%, 12%. If a stock is crazy high, that's usually a red flag. It often means the company is struggling. You'll want to look at its free cash flow and its history. Just because it's paying out a high dividend doesn't mean it's making money, right? It might be in a death spiral or simply returning investor money. Like, hey, I bought this thing and it's just giving you your money back. I'd rather have a rock solid 4% dividend for 30 years than a 12% dividend that gets cut 6 months later in a company that implodes, right? I am looking long term. Okay, now I mentioned the terms covered calls and cash secured puts, right? Well, let me explain these in the simplest way possible. Think real estate. A covered call is the equivalent to renting out a property you own, right? If I buy a house, I don't want to just let it sit there empty. I want to rent it to somebody so I can get paid. With a covered call, you get paid up front. And then maybe somebody buys the house later. They're buying it, you're giving an option, they're going to buy it at the stock at a greater price, a higher price than it is worth today. Maybe they do, maybe they don't, right? If the stock runs up, maybe they do. Either way, you keep the cash. You get to keep that premium. Now, a cash secured put is getting paid to wait for a better price. It's like saying, hey, there's a house. I would pay $400,000 for that house. But I am going to say, you can pay me, and I promise you I'll pay $385 for a period of time. 300. I would buy that house for 400. This is going to break your brain a little bit, but I will let them pay me to buy it at 385. And you're like, wait a second, that sounds crazy because it's less than the 400, right? But that's how it works. It works for stocks, for example. You might be looking at ABC Inc. and you're thinking ABC is at $100. That's a great price. But what if somebody said, hey, I'll pay you $1 if I can make you buy ABC for $95 for the next couple of weeks? Okay, you just have to have the money in your account to buy those shares. And that's what we call a cash secured put. That's all it is. It's simple. Somebody's paying you to force you to buy it at a price lower than it is. Which, again, the only time they're going to do that is if the stock drops below that point. But you would have bought it at $100 anyway. Now you're buying it at 95, and you get to keep the dollar. And here's what happens. For most of the stocks we look at, about 80, 90% of them, you just always keep the money. And you never have to buy the stock. And sometimes you end up buying the stock, but you would have bought it anyway at that valuation. And by the way, you can probably tell that these are conservative income-first strategies, right? We're getting paid on the front end. We're not waiting for something to go up to get paid. This is not gambling. And so why do you oftentimes hear horror stories about option traders, by the way? Put another way, what is the biggest mistakes? What are the biggest mistakes beginners make with options? Well, many people learn option buying, meaning to make money, you need to be right on 2 out of 3 things, right? If the stock goes down, I buy an option to buy ABC Inc., and I'm like thinking it's $100, and I buy an option to buy it at 105, hoping it goes to 110. If the stock goes down, you lose. If the stock stays the same, you lose. Only if the stock goes up do you win under that scenario. We avoid that because we're the seller, not the buyer, right? If the stock goes down, we win. Stays the same, we win. Even when it goes up, we win. We're the casino, not the gambler. So why don't people yell and scream about this strategy? Because it isn't sexy. It's like being the guy dealing the cards at the casino. That's not sexy. The one guy who wins at the table, everybody else lost. But the one guy who wins, he gets the press, right? Hey! And we're okay, by the way, being the casino, getting paid consistently, and foregoing the occasional big win, which is more often just a path to bigger losses. So I see beginner investors jumping headfirst into option buying and think, I think, like, good grief, like you have about a 5% chance, tops, of making money. It's no different than when I live in Las Vegas. I watch people sometimes gamble in Vegas. I'm not a gambler, I don't gamble, but I'll go to the casino, I'll watch those people. And those casinos weren't built because the casinos lose, right? These are massive billion-dollar buildings. The gamblers lose. For the rest of the folks out there that are trading options, the 3 biggest mistakes are selling options on risky, volatile stocks, or they're chasing big premium, or they panic. They don't know how to plan for their exit, which is why you really want to have, this is what happens. I know my exit before I enter, and good option investing is really kind of boring, right? If it feels exciting, you're doing something wrong. The exciting part is that you get this cash flow, but it is boring as heck. It's watching paint dry. But what about beginners? Can you start with a small amount of money and do this? Is that something I can even do? Well, you don't need wealth to start. You just need consistency. This is what it is. It's time and consistent. And so here's a simple infinity blueprint for beginners. Number 1, I'm just going to start with the first $1,000, and you're going to use a 10%, 90% rule, right? We fill buckets. We call it the 30, 30, 30, 10. 30% goes into dividend producing stocks, 30% goes into real estate or real estate equivalents, then 30% goes into managed portfolio, 10% is always going into cash or cash equivalents. So we start with bucket number 1. So the first $1,000, 10% would go into cash. Or, when I say cash, it could be Bitcoin, gold, US dollars. 90% goes into quality dividend stock. So you're going to take that $900 and you're going to build and start buying your first 100 shares. The reason we want to get to 100 shares of any particular company is because you can sell covered calls once you have 100 shares. So one covered call is for 100 shares of stock. So then you begin selling covered calls and you repeat until your snowball grows. Right, so I use an infinity calculator to stay accountable. And by the way, that's in the infinity system. You'll see that you can plug into your numbers and it tells you how many days you could live off of your existing asset base and based off of your existing income types. So if you're doing covered calls and you start getting dividend premium, those start lowering, it makes the number of days that you could live that much longer, right? So that you can get to that infinity where I don't have to work anymore. And by the way, just to get the free book, just go in the show notes, click on the link, and you can download the ebook of Infinity Investing. And you could join some of those classes. We have a bunch of free classes where we teach these strategies. Right. The goal is to learn, by the way. So you started with $1,000, right? We're trying to get there. Maybe it's $100 a month, whatever it is. The goal is to learn while you are getting started. And the best way for me, I always say pick an individual stock so you can learn about it, but you could use ETFs too. But for learning purposes, nothing is better than buying a good dividend aristocrat or king and learning about it. It triggers something in your memory when you're learning about a stock if it becomes relevant. And so you start looking at, like when you look at its financials and you start looking at its income statement, it'll become relevant now that you own the stock. Or you're looking at its dividend yield and you're starting to look at the numbers and you're looking at its chart and you get familiar with it. It's a great learning ground. And those small steps compound into big results faster than you think. Right, so if you want to dive deeper and start building cash flow the right way, again, I want to give you a free copy of my Infinity Investing book. By the way, it won a gold medal and it was a bestseller on Amazon, but I'll give it away. Just click the link in the description, it's yours. There's no catch on this, by the way. I just want you to read it and get to know it. And if you want weekly guidance, strategies, and market updates, well, here's an easy thing you can do. First off, subscribe here on this YouTube channel. Just like and subscribe, it really helps us. You can visit infinityinvesting.com. You could join some of our free workshops, or you just connect with us at andersonadvisors.com. It's the same company. Anderson Advisors owns Infinity Investing. And why do we do it? Because we want people to build wealth. Anderson Advisors, we've been protecting assets and doing tax strategies for decades. In order to have a tax problem, you need to have a wealth problem, right? You need to have money coming in. So we want you to be very, very successful because then, hey, we'd love you to come over. We could do some tax planning because you're making too much money. And that's it. So like and subscribe, guys. Share this with anybody you think will benefit. And thank you for watching. Now, by the way, go build income that pays you for life.